What's going on, my fellow wealth creators? Matty Ice here. Welcome to another training. Today, I want to share a really good conversation I just had with my friend Michael Garcia from IC Life, where we are talking about Ethos and their simplified issue, index universal life policy. Okay. Basically, simplified issue, what that means is that the life insurance company is not going through a complete underwriting process where they are requiring a medical exam, blood and urine samples, which is typical of permanent life insurance policies, especially with higher death benefits, things like that. That's usually what the life insurance company requires people to go through so that they can assess the risk involved based on their data, their actuarial data and things like that. And basically it helps them determine what they need to charge in order for the amount of coverage that you are requesting, right? So they can meet that obligation. Okay. Well, with simplified issue, they're not going through any of that. They don't go through the same underwriting process. It's basically surface level type of underwriting where, okay, they're going to ask you, questions like, what your weight is, how tall are you? Do you have any medical issues? They might do like a medical questionnaire. They'll do an MIB report, things like that. Okay. So they'll do the basics, but they're not doing full, complete underwriting. So what that means is that the life insurance company is now taking on more risk by not going through the full underwriting process, which means they need to be compensated, which means they're passing those costs on to you as the consumer. So if you are a consumer looking into potentially purchasing an IUL and you're working with an agent that is going to sell you a policy from Ethos, you need to know that, because that might not be the best policy for you. Not to mention, IUL, I'm not a fan of IUL at all. There's already so many things that can go wrong with an IUL. Now we're talking about simplified issue where they're not going through underwriting just so that you can get approved a lot faster so the agent gets paid faster, because that's really the only benefit here, guys, is the agent gets paid faster. The fact that you can get approved so much faster with this simplified issue IUL does nothing for you whatsoever. And here's the thing, this is part of what I was talking about with Michael in this conversation, is that these types of decisions that you're making with these types of products, they should take a little while. They should take a few weeks. It should take a couple of months, because it's such a major financial decision. We want to make sure that you're getting the right policy and that you're getting the best rating, et cetera. You want to go through the medical exam so that you get the best rating possible. And because that can have a significant impact on the performance of your policy long term. All right. So the point of this video was to just bring awareness to consumers. Like if you're considering an IUL, which I would absolutely not recommend, but if you are considering it, I just want you to be aware of the types of products out there and the marketing around this. Man, it's so misleading. And the fact that you're able to get approved for an IUL in 15 minutes or just like instant approval really quick, like that's not a benefit to you as the consumer. Like it only benefits the agents. It just means that they get paid faster. That's it. And you end up paying more for the same type of policy that you would get with a different company. And it's really, really frustrating, because you have to think too, like how do those extra costs for that simplified issue impact the long-term performance of your policy? You need to know this so you can ask your agent that, right? Is this a simplified issue policy? And if so, what does that do for the long-term performance of my policy versus a non-simplified issue policy? If I were to go through the full underwriting process, get the medical exam, provide the blood and urine sample, et cetera, whatever the life insurance company requires, what's the difference? Right. And look at the difference in the impact of what that does on your policy. So, I really have a problem with this kind of stuff. There's so much moral hazard surrounding it, because it's all about sales with this type of IUL. It's all about how fast can the agent get paid. And I have a real problem with that, because these are major financial decisions that people are making. It needs to be in the best interest of the consumer. And I just don't see that with a product like this. So anyways, let's go ahead and get into it. If you guys have any questions, feedback, drop them in the comments. I would love to hear them. I hope you enjoy the conversation. I hope you get a lot of value out of it. And let's get into it. Here we go. All right, go StreamYard. All right, let's have some fun, man. What's going on, my fellow wealth creators? I probably already did an intro, but I'm going to do it anyways. Again, I got Michael Garcia here, good friend of mine from IC Life. And we've done some content in the past, had some good conversations. And we were recently on the Life 180 panel a couple of days ago doing content. And I reached out to Michael afterwards. It was like, man, I feel like we need to do some more content on what we were talking about, because, man, we only made it through about halfway through the video, but it was about Ethos and their like simplified issue, like where their IULs can get approved like really, really fast. And it introduces the concept of the one call close for IUL and stuff. And for me, it just makes my skin crawl, man. Like, I already don't like IUL very much. That's not to say that like nobody should buy it, maybe, I guess. But my problem is that people don't know what they're buying. They don't know what can go wrong with these things. And now we have, these agents, they have the ability to sell an IUL in 15 minutes, 20 minutes, and get people approved for this product that has a very, very long-term impact on their finances. And they have no idea what they actually purchase. They just know, all they hear is like all the tax-free retirement income. And, it's so much better than a 401k because you can't lose money in the markets and stuff like that. And it sounds really good and it looks really good on paper. And I know this because I almost purchased an IUL, but now we have this product that agents are able to sell and like really, really fast. And it's like, how do you know this is actually good for somebody in such a short amount of time? And, we were going through the video that, what was his name, from Ethos, Peter Colas, and he was interviewing Eric Olson from GFI, the new multi-level marketing company that's selling IUL and stuff and other financial services. And man, some of the things he was saying was really, really concerning to me. And I just, one of the main reasons I started my channel, guys, is to help you understand like what the risks are with these types of products, with IUL specifically, because again, I almost bought one, and because I drank the IUL Kool-Aid. It sounded like an amazing product, and maybe for the right person it is, but I didn't know what I didn't know. And then when I did, I wanted nothing to do with IUL. So now that it's being sold like this, man, it's just it's really concerning to me. So Michael, I really appreciate you being here. I think this could be a really good conversation where, we're just letting people know how these things work and what to be careful of. And like, it's not, like I said, it sounds like an amazing product and stuff like that. And they make it look really good with their presentations and, and all that stuff. And I just, I think a lot of people, unfortunately, are going to get hurt by these things because they don't understand what they actually are. So I appreciate you being here. I think this is going to be really good for people just to expose like, hey, these are the things that you need to look out for with this type of product. So anyways, I really appreciate you being here, man. I'm looking forward to this.
I appreciate being on the channel and you invited me. Yeah, it's definitely a topic that I'm passionate about too.
Yeah, man.
I came from that. That was the way I got brought up in the industry, was selling IUL, and I didn't know what I didn't know. So, yeah. and I wasn't told certain things, and I had to find out on my own, do my own research. And I started realizing like, hey, this isn't exactly what it's cracked up to be.
Right. I think that's the most important part, is just doing your own research. Like I tell people all the time, don't take my word for this. Like anything I say on my channel, don't take my word for it. I'm just sharing my journey, what I have learned, what my experience has been. Take what I say and go do your own research. That is the most important part. Like, okay, it sounds really good, but what do we actually know about it? Okay. What else do we need to know about it before we make a decision? Do your own research. Maybe IUL makes sense. Maybe dividend paying whole life insurance makes sense. It absolutely did for me. Maybe neither of them do. Maybe buy term and invest the difference. Go dump all your money into the 401k. Maybe that makes sense for you. I don't know. But you got to do your research. So, Michael, let's start with this. Give me just like, because we only got through halfway. Like we got halfway through that video. What was your experience listening to that video? Listening to the conversation that Peter and Eric were having? And like, what did you take away from it?
I mean, I wouldn't sign up with that company.
GFI?
Yeah. I mean, to me, it's it's just money hungry people, right? It's my pockets over anything else. And that's what I hear when we're going through that video. And for all the talk about helping people, it's like, but are you actually helping people?
Yeah.
Or you're only helping your top agents that are helping you with your money grab here?
Right.
That's what I got. So
yeah, get into the living this luxurious lifestyle and stuff. And look, I don't have a problem with people making money. I love making money. I want everybody to make as much money as possible. But how are you making that money, man? That's what you really got to ask yourself. So, what do you think is, in your opinion, the biggest? What would you say the biggest issue, at least on your end? What's the biggest issue with these simplified issue? Get approved in 15-minute type of IUL. Like, what do you see? What do you see as the biggest issues with it?
Yeah, well, I mean, we got some major issues with IUL just in general, right? And that has to do.
It's bad enough already.
And the concept is great, actually, right? The concept is a great concept. The problem is the contract, right? It's when you sign that contract, what are you signing, right? You're handing over. You have no ownership, right? You're a policyholder, but you're not partaking in that company's success, right? You're not owner of that company like you are with the participating whole life of a mutual company. And then not only that, but when you read the contract, you realize that there's all these levers the insurance company can pull, right? So they can change the cost of insurance on you. They can change the cap rates, the participation rates. There's a lot of different things that they can change in that contract. In fact, I think we read off a whole list. There was like 10 different things when we did a video before on NLG, right? We read it right out of the contract.
That. Yeah.
And I can't even remember what all those things are. But those are kind of the main things, right? The cap rates, the par rates, the cost of insurance, right? The per 1,000. And so, yeah, we've seen it in the past, right? We just had Transamerica paid out multiple millions of dollars nationwide. John Hancock. You have a lot of Lincoln. You have a lot of companies that to meet certain guarantees in universal life products. Keep in mind, Index Universal Life is just a updated version of Universal with an option strategy attached.
Right.
But they got in trouble because they had to meet the low guarantees. But instead of just honoring those guarantees, what did they do? They raised the cost of insurance to offset. Basically, the client was paying themselves that guarantee, right? They offset it with the cost of insurance. So that's what these contracts allow these insurance companies to do in any case, right? But the problem with simplified issue is you already have to outperform the cost of insurance. You have to and remember, it's an increasing cost. It's an annual renewable term, right? There's keys to that, right? You can manage the net amount at risk and things like that, but so you can technically lower it in a total perspective, but from a per 1,000 cost, it's going to cost more, right? And so because of that, you have to outperform. You have to have enough money in that policy to kind of weigh out those later years, right? The interest has to be enough to pay the cost. And when you're talking about what people call LERP. I know we talked about LERPies. We talked about LERPies on that one. We made it a thing. It's official. But you have a cost to borrowing too. So you have and people say, oh, there's 5% guaranteed on certain products. Some products it's 8%. But at the end of the day, whether it's 5 or 8%, and then you add a cost of insurance, maybe it's an additional 1%, right? So that's 6%. Well, if the insurance company can cap you at 6%, they can basically guarantee you're going to lose every year.
Yeah.
Right. Like, and it's not, they win when you lose. They don't have to pay you out. So number one, that's the issue. But when it comes to simplified issue, it's even worse because you have to build up that cash value. The problem is on simplified issue products is you're looking at table C, most of the time table D.
What is that?
And
explain that really quick for the audience.
Right? So it's a substandard rating, right? What these companies do is they're saying, okay, we're gonna avoid the underwriting process. We're not going to thoroughly underwrite it. We're going to just look at, maybe your MIB report.
Right.
And we're going to say, okay, well, everything looks good. They meet the height and weight criteria.
Sure. On the surface, everything looks good.
On the surface, everything looks good. So we're not going to dive into it. We're going to approve. Right. But what happens is they're taking on more risk.
Oh, yeah.
Right. Because they didn't 100%. Do their due diligence.
Right.
Well, insurance companies, the client pays for that. Right.
So Michael, what you're telling me is that when you get something from the life insurance company, you're giving something else up in return, in exchange for that?
Always.
That's how this game works, guys.
So you're managing risk, right? The insurance companies, that's what they're doing. And
which here's the thing, it's not necessarily a bad thing, but it goes back to what I said earlier, is who is this benefiting? Like, does it really benefit people to get approved in 15 minutes for an IUL, for this life insurance retirement plan, this LIRP, right? That's going to give you all this tax-free retirement income. You're going to dump a bunch of money into this for your entire life. Like, who's benefiting from that exchange? Because it comes down to the value that you're receiving in exchange. Like, so if you're giving something up in exchange for something else, but that thing that you're getting is more valuable than what you're giving up, okay, that's a win for you. But in this particular case with simplified issue IUL, the only, correct me if I'm wrong, maybe you see this a little bit different, Michael. I would love to hear your perspective on it, but the only benefit I see is to the agent because they get paid faster. That's it. That's the only benefit I see in this particular scenario, right? And you're saying that because it's simplified issue, maybe they do the MIB report and stuff like that. Like they're only underwriting based on the surface level here. Well, guys, I just did a video on this on my channel the other day. And this what I'm about to tell you is what the life insurance company is making up for in the why it's more expensive, I guess you would is the simple way to say it, for something like this, is because they're making up for what I'm about to tell you. So I was working with a client that we were trying to set up a policy. We had an application in, and 5 days before his medical exam, he almost had a heart attack. On the surface, he was good. No medical issues, a little bit overweight, but nothing crazy. He didn't have any, past medical issues or anything like that. Nothing wrong. He's not on any prescriptions or anything like that. And 5 days before his medical exam, he almost had a heart attack. So if the life insurance company is doing the simplified issue with these IULs, they are taking those types of scenarios into account, which means more costs, right? They have to compensate for situations like that because they know that's going to happen. So that's part of the underwriting process, or maybe not the underwriting process, but the overall cost, right? Michael, correct me if I'm wrong on that.
No, absolutely. Keep in mind, IUL is the biggest profit center for these insurance companies, right? They make the most money off of IULs. But yeah, when you inject that risk, right, they're not underwriting it, you're going to pay for it. You're going to. And so the way these table ratings work is each table rating is 25%. It's considered a substandard rating. So you have your standard rating, and then you could actually earn a better rating, right? If you're really healthy, you get a preferred, you get even like a preferred plus. Each rating is 25%. So if you got a table A, which is substandard by one level, or table 1, you would pay 125% on your premium, your cost of insurance. Now in term, you would see it directly in the premium, right? If you had $100 premium, all of a sudden your premium would be 125.
Right.
But in IUL, because you're paying extra that goes into the cash value,
right? Yeah.
You might not see it in the premium, but that cost of insurance is higher, meaning less of that money is going into the cash value, right? So you'll see it in the cash value being lower, but you won't necessarily see it in that monthly premium, right? So table D is what most of these carriers, when they do an instant decision, is they're saying, hey, we're not checking everything, so we're taking on this extra risk. So we're going to give a table D. That means you're paying 200% of the standard rating.
Right. They need to compensate for that, and they pass those costs on to you.
Right.
And then the question becomes, what does that do to the long-term performance of your IUL?
Yeah, well, it eats away at
how does that drag on the cash value over the long run?
Yeah, it eats away at the performance, right? Because you're paying 200%. That means it's less in the cash value, it's less compounding. And by the way, as an annual renewable term increases, right, you got to manage that net amount of risk in the policy, but still it's going to be even double as you go.
Right. So then the other part of this conversation too, again, it's the only benefit I see for something like an Ethos product where it's almost instant decision is to the agent, because if you're going to do an IUL, which I would never recommend, but if you're going to do it, obviously you want to make sure you get the best policy for you, right? And if does a policy with additional costs that's going to put drag on the performance of that policy long term, just so you can get approved in 15 minutes instead of a few weeks, is that worth it? If the answer to that question is yes, then I suppose go for it. But I don't think, like, if people understood the consequences of this, like what they're giving up in order to get a quick 15-minute approval, like that's not benefiting you, that's benefiting the agent. So is it worth it? No. It's like if you're setting this up for a long-term, as a long-term asset in your life, okay, we want to make sure that's the best asset you can get. And if it takes a few weeks of going through underwriting and doing a medical exam and stuff like that, and that will make it better, I think 99 out of 100 people would say, I'd rather go through the longer underwriting process than 15 minutes, right? Yeah. Because there's you as the client get zero benefit from that. You're actually paying. You're paying for that so that the agent, you are paying so that the agent gets paid faster. That's what you're doing.
Yeah.
Does that sound like a good deal? Not to be.
Yeah. I mean, basically that's all it is, right? The agent gets paid faster, and that's the big appeal for the agent to sell it.
Right.
Right. But it's definitely not what's best for the client. And I'll give you an example, Matt. I recently had a client, and she had an instant decision product, a term, and she was paying $170. Right. Now, remember, different carriers are going to be even better priced too. So we ended up getting her, we got her preferred.
This was for a regular term product?
Yeah. Yeah. We got her preferred, and she ended up paying $70 a month. Same coverage. $100 difference.
Right.
You take that $100, you multiply it by 12. That's $1,200 a year. You multiply that by a 30-year term. Yep. And keep in mind, IUL doesn't end after, like, the costs don't end after 30 years. Right. The costs are
premiums still do
lifetime. Mm-hmm. But that's $36,000, right? And that's on a small premium. So you start going into IUL, you start going into lifetime and bigger premiums, and yeah, you got to ask yourself, like, is it worth right. that kind of cost?
It's interesting you bring that up. I have a client I'm working with right now. She wants to do she wants to do a 30-year term policy, convertible term policy, because eventually they want to turn it into whole life, use infinite banking and all that stuff because they do real estate. She wants to buy a 30-year term policy on both of her sons. And when I just ran simple quote, whatever, it was actually quite a bit cheaper than what she had seen online, because a lot of the times what you see online are those instant issue types of policies, and you're paying more for that. Sometimes you could pay significantly more for that. So that's a great example you provided, where she's paying $170 a month. Now she's paying $70 a month for the same exact coverage. That's a perfect example of, again, what are you giving up in exchange for an instant decision, and is it worth it? Like, to me, just go through the regular underwriting process. It's going to be a lot more cost effective. It's going to be much more beneficial long term for your policy. It's going to be a lot more efficient, right? And like those instant issues things, like, yeah, working with my client too. She's like, yeah, that sounds really good. You know, when I gave her the quote for it, like, yeah, that's a lot cheaper than what I was seeing online, and it's a good example of it. Yeah,
it's always going to be cheaper to go underwritten, unless the client's like super unhealthy. And the way I describe it, Matt, to my clients, because sometimes I got to tell them, like, hey, like you should probably have the medical exam, right? And by the way, when you apply for these, they don't always necessarily require a medical exam. Sometimes they go into accelerated underwriting and you still get the great rate, but they do hold that right to go ahead and say, hey, we're going to do a medical exam. Like we're going to check things out a little deeper here.
And a lot of that depends too on how much coverage that you're asking for, what your age is, things like that.
Right. But like in this case, right, is it worth $36,000 for you to have a nurse come over for 15 minutes?
I would say so.
I would say so too, right? Yeah. So, you got to take those things.
Take as much blood and urine as you need, okay, for that.
Like, like, is it really worth 36 grand to avoid the medical exam? And the way I explain to my clients too is like, when you were in college, right? You had two options. You could take a letter grade, A, B, C, D, or F, right? Everything above a D is passing. Right. But if you're an A student, you wanted credit for an A because you were good at what you did. Right.
Right.
Or you could take a pass fail. Right. And it didn't matter if you got a 95% in that class or you got a 60% in that class, you passed. Right. And that's all that shows. And so when you think about it in those terms, when you go simplified issue, you just get a pass credit, meaning you're getting the same rating as all the D students in their health.
Right. So you're paying the extra insurance cost for the people who are unhealthy that are getting approved.
Yeah. You're paying 200 to 300% what you should be paying.
Right. That's awesome. That's a great example, man.
Yeah. If you're an A student, you want credit. You want that credit.
You want the best rating, man.
Yeah.
Right. You want the scholarship. You want the whatever. Like, you want the benefits of doing well. Same exact thing with life insurance. If you take care of yourself, you're in good health, you're young, and you're making that decision to get life insurance, you should get the best rating. You deserve that. 100%. You shouldn't be paying for everybody else, right? That's just not good. Here's the other thing too, with like the issue that I see with these instant issues is this simplified underwriting and instant issue IUL is that the moral hazard involved with selling it. Like it just becomes about making the sale, making money, getting paid as fast as possible versus taking your time to make sure that you're doing what's best for the client and making sure that you're finding the best product, the best policy for the client as well. Instead of, hey, I've got this one product right here. Or maybe they have a couple, but if they're all simplified issue, again, there's a lot of problems with that from a long-term cost standpoint. But instead of saying like, this is the only company that I work with because it's the one I get paid the fastest with. Like, I just see so much moral hazard there. And my question is with these types of things is, do you really know enough about somebody's situation, what their goals are, what their needs are, to get them to make a major financial decision in one call? Because like I could just see this like one call close IUL type of crap, where again, it's all about making the sale. Like, did you really get all the information that you need? Did you really take your time? Did you get on multiple calls, or are you just trying to make the sale? Because I have somebody I'm working with right now, man. He's a good friend of mine now, and I think we've been working on his stuff for months now. Because some things come up, like, obviously it's not always the case, but some things have come up. And I remember before we even submitted the application, we were on multiple calls, and even throughout the application process now, it's been weeks, where the life insurance company needs this information, they need that information, they're doing their due diligence. But it's 100% worth it because we found the right product, the right policy for him. We set it up exactly the way that he needed for his specific situation. And now, we're going through the process. It takes time. We're making major long-term financial decisions here. It should take time. You want it to take time. You don't want it to get approved in 15 minutes. Like how do you, again, just circling back, bring it home. And then I'd love to hear your thoughts on this, Michael. It's just the potential for the massive amount of moral hazard here with these really quick IUL closes. you're not setting people up for success. These agents sometimes, they think they're helping people. Are you really? Or are we potentially doing massive damage here by setting up a product for people? They don't know how it works, which we'll get into, but they're dumping a bunch of money into it. And is it the best product for them? Right? Or are you just selling it because you get paid faster? Like, it makes my skin crawl. Go ahead. What do you got on that?
Yeah. I mean, first of all, forget understanding the client's situation or what they value. You can't even explain IUL in one sitting. Right. You can't even educate a client on a product in one sitting.
Yeah. Do people really understand how your IUL works in one sitting, in one call? Come on, dude.
No, the problem is, so here's what I see I have my own personal issue with Ethos as well. But one of the things that I see when I see these companies partner with Ethos, I've seen a couple do it at this point, is there's a couple things in common, right? And we saw it in that video where all Eric Olson talked about was the agents can make money fast. The agents can make money fast. The agents can make money fast. And that's all it was about, right? And we've seen that with other companies too in the past, where Ethos has partnered with them, and it's all about just making money or winning a car. I remember we had the car contest with one of those companies, right? And so it's like, it's just about making money for the agent. It's never about actually helping the client, right? And that's the issue that I see. And it's what I see in common. The other thing I see in common is, well, they don't educate the client on IUL because the agents at these places don't know IUL.
Right. Yeah.
They
most of them don't.
Right. Yep. And I happen to know one of them, and I know they have like an advanced markets team that's supposed to help. And the advanced markets team really doesn't know IUL.
They only know enough to make sure they're able to sell it. That's it.
Yeah.
They know how to make it sound really good and look really good on paper.
Yeah. And the problem too is you get all this hype, right? And you get a case of the Lurpies, right? You start calling
financially transmitted disease.
Exactly.
I love that.
You start to sell it as something it's not. And that's where you're going to have problems, right? Because guess what? It's a life insurance policy. Is it the best life insurance policy? I don't think so. But you know what? If you sell it as a life insurance policy, it can perform as a life insurance policy just fine.
Sure.
Right.
That's not how it's sold, though.
Some of them have guarantees. Some of them you can guarantee the result. Right. And I have no problem selling an IUL where I can guarantee that what I'm telling the client is going to happen.
Sure.
Right. The problem is when you take it and you make it into a LIRP or, life insurance retirement plan, when life insurance is not meant to be a retirement plan. Right. It's a backstop. It's your protection. And so you're trying to make it into something it's not. And then when you ask it to perform in a way it wasn't really designed to perform, that's where the issues come in play.
Right. Yeah. And some you mentioned earlier about, this it's all about making sales and making money, for these agents and stuff. And what's really frustrating about that for me is that it's such short-term thinking, because if you do the right thing by people, instead of worrying about getting paid on the same day, because with this simplified issue, if you were thinking long-term and actually trying to help people with really good products and, based on what they need, take your time and stuff, you can still make really good money in this business. Yeah. You can do that by doing the right thing. Maybe it doesn't happen as fast as being able to do a one-call close IUL, but you could still make great money long-term in this business. And it's just so frustrating, like the short-term thinking. It's all about making the sale right now. And it's just, it's really frustrating. And, I was watching a video earlier, Michael, about IUL, and this guy was going through, he's breaking down a 7-year-old IUL policy and showing the rates of return and stuff like that. And, there's a couple of things I got from it. I'd love to get your take on this as well. Like just the complete disregard for the cost, fees, eventually the interest costs and stuff like that. Like, oh, it's just not a big deal. He like straight up said, like, I'm just like, if you're bringing that kind of stuff up, I just don't respect you anymore, or whatever. It's like just the complete disregard for what these policies do. Not to mention 7 years. I mean, really, we're looking at 7 years of performance, and the performance wasn't even that great. His point is the rate of return that has been that the performance of the policy so far, is it close to what was illustrated? The answer was yes. So he illustrated like 6.5%. The policy did 6.5%. But I thought to myself, number one, is that net of cost, fees? Number one. Number two, it's not even like, I don't think either of us argue that an IUL won't perform, like it won't get interest, like good interest credits on some years and stuff like that, and that it won't accumulate cash value. But the problem shows up with IUL really later on when people are much older and that cost of insurance per 1,000 has significantly increased. You start taking policy loans and you have this massive loan balance with not nearly as much cash value as you thought you were going to have, because the market doesn't go up every single year. That's where the issues really start to play out. And I asked myself, when he was showing the 6.5% on average that the policy has done, is that worth is it worth all the risk? Is it worth the additional 1 or 2 potential percentage points more of growth that you'll get in an IUL than a whole life policy? And I couldn't see it. It was not worth all the risk, all the things that could change, all the things that could go wrong with it. And again, just the downplay of how impactful that cost of insurance is going to be, having to manage that amount of risk. What's going to happen with cap rates, participation rates, spread charges, like, all this crap. And just he downplayed it so much. And it really, really bothered me. And the question is, like, is this extra potential growth that you might get, is it worth it? And also, what are you going to be able to do with that later on down the road? Like, do you know the impact of a really big loan balance on an IUL during retirement? What happens when you have that 0 year? Where does it come from? The interest cost and cost of insurance and all this. It's like, none of that is explained to people, especially in a 15-minute or a simplified issue IUL. None of that is explained.
Yeah.
And to me, it's not worth the risk. Not to mention, like, I bring it up all the time, you can get upside potential, downside protection in the market with a whole life product. So could you maybe do 6 to 7% like an IUL in that example with a whole life policy and avoid all the issues of IUL? Sure, maybe, because it's depending on the market, but you can get that with a whole life product and not have all the problems of IUL. So it's like, why does IUL even exist when it comes to retirement planning and all this stuff? It just doesn't make any sense to me. So a little bit of a rant there, but it was something that I saw earlier, really, really bugged me. What are your thoughts on stuff like that?
Well, the answer is it wasn't a retirement plan. It just got started. It started to be marketed as a retirement plan. It's life insurance. So that's why it exists, because it's life insurance, right? It's a flexible premium life insurance that, for the most part, I believe will do its job. But yeah, you got to ask yourself, it's about your position, right? So you talk about like the 6.5%. Is it worth it? Well, keep in mind, like, that's why those articles, like, it's important to know the history, right? It's like, yeah, we've seen this before. You can maintain the cap rates to keep a 6.5%, but where are they getting that from? Right? Because remember, there's multiple levers. If they need to, they can get it from the cost of insurance, and you could be paying for that 6.5%, right? And you wouldn't even know it. But guess what? When your statement comes in, they're still going to say, "Hey, look, we got 6.5%," right? That's not the internal rate of return.
Right. That's just the interest credit.
That's the interest credit, right? And so you got to know the history, and you got to understand. And I always say this, like, I saw DMX say this: trust a snake to be a snake. Well, trust the company to be who they are, right? Yeah. If they have a history where they've had, lawsuits and they've paid out settlements, We had that article, Transamerica, like I said, Nationwide, all these companies were on this article of, hey, they paid out this amount, and hey, trust them to be who they are. That's all I got to say. Um, I always say this too. You always want to align. This is a lesson from Richest Man in Babylon, right? Two things you want to do with your money. You want to give it to someone who knows what they're doing, first of all, right? But you also want to give it to somebody who wins if you win, right?
I like that.
And when you own a stock, if that company grows and they win, guess what? You as a stockholder, you win.
Right.
You put your money with a financial advisor, and they're on a fee basis. Well, guess what? If they grow your portfolio, that's a bigger fee, right? Because it's all percentage based. So if you win, they win. If you get a participating whole life and you're owner of the company, by definition, if the company wins, you win as the owner, right? And in IUL, not the case, right? That the insurance company's always going to win. Now, do I think they're going to intentionally be out to get you? I don't think so, right? Yeah. But keep in mind, they're going to win. Mm-hmm. They win first. And if you happen to win, great. And if you don't, as long as they protect themselves, because what do? They manage risk.
Right.
So they're taking that risk. They're putting it back on you through the contract, right? The contract says we can pull these levers if we need to. And, these companies have pulled the levers even when they maybe necessarily didn't need to. And that's what these lawsuits are about. So,
And the question for that is it worth it? Like, are you being compensated enough for the life insurance company putting that risk back on you? If you say yes, then it makes sense for you, I guess. Right. But when I see, like earlier, 6.5%, 7.26%, I think was the highest. Is that worth transferring the risk back onto me? And all of the things that can change in an IUL. That's not a good enough potential return. Not to mention that's just an interest credit. That's does not include cost of insurance, fees, all this other stuff, right? And some of that can be managed, but to me, I just don't see it as being worth the risk for all the levers that they can pull, all the things that could change, all the things that I'm not in control of. Right. So like with my policies, because I set up 2 dividend paying whole life insurance policies, I implement the infinite banking concept in my life. It is fantastic. And I'm willing, like once I understood how these things worked, it was a no-brainer for me to sacrifice the potential, which I don't think would actually happen anyways. But let's say it did. If my IUL policy, if I had one, were to grow, the average was 7%, 6 or 7%, and my whole life policy is only 4%, I'm willing to sacrifice those extra potential percentage points of growth because it's not worth the risk. It's not worth all the things that could go wrong for me based on my risk profile. Because I also, my plan with the policies too is to use them to build wealth in my own way. Like I'm not relying on my life insurance policy to build a massive amount of wealth for me. It's going to get that 3 to 5% tax-free, uninterrupted compound growth, and that's going to look really good in 40 years when I'm 75. Right? That's going to look really good. Uninterrupted compound growth is really powerful, which just so you guys know, IULs don't get. Anytime you have a 0 year and that cost of insurance fees, whatever's coming out, you're going backwards. That's the opposite of uninterrupted compound growth. Okay, just so you're aware. Right. So when you see that illustration showing growth every single year, not going to happen. Okay. But I'm not relying on my policies necessarily to build wealth. I want control of my money and to put it in the most efficient vehicle possible. If I'm going to save money for emergencies and opportunities, why not save it in the most efficient way possible? And the bonus of that with these policies is that uninterrupted 3 to 5%. I'm okay with that. And now I can go use it to lend on real estate or flip equipment. That's what I'm doing right now. Instead of relying on this fantasy land illustration 6 to 7% every single year. It's based on the stock market. You don't know what the cap rates are going to do, what the participation rates are going to do, what the cost of call options is going to do, the options budget based on the general fund, the general accounts as well. Like, all these things are completely out of your control. Is the risk of all those things I just talked about, is it worth the extra 1 to maybe 3 percentage points of potential growth? I don't see it, man. And not to mention, you can get that with a whole life policy too, with the indexing option rider. But
yeah. Well, the reality is the only number that matters isn't the interest credit, it's the rate of return.
Yeah. What does your policy actually do?
So you're really fighting for maybe 50 basis points.
Yeah.
I mean, it's not that big of a difference. And I think the other thing you got to keep in mind, like you mentioned, the guy who said, oh, the first 7 years. Well, remember, these companies bump up their rates in the first, for the new business. Sure. Right. Almost every single company, the only company, there's two, the company I know that like I trust. And like I said, trust someone to be who they are. Right. Columbus Life prides themselves on not lowering the cap rates for their older book of business. But that doesn't mean they can't.
Sure.
Right.
So it doesn't mean they can't pull a different lever either.
Right. So you gotta pay attention. But we know, like, these companies lower these cap rates, right? They illustrated at this rate, and now they're maybe 7%.
Right.
So when you say those 7 years, yeah, it performed for those first 7 years, but what were the cap rates on average those first 7 years, and what are they today?
Sure.
Can they even average?
Changed? Yeah.
Can they even average that same percentage going forward?
Sure. Yep. What changed throughout those 7 years?
Yeah.
So that would be a really good question to ask an agent showing you something like that. Like, hey, over the last 7 years, here's what this type of policy has done. Oh, okay. What's changed? How did it start? How many times have the cap rates changed? How many times have participation rates changed? What happened with your proprietary indexes? Because the other thing too is the complexity of these products. Again, for me, to earn 6.5 to 7% on average is not worth the additional stress on me to have to manage these things as well. Because he showed the money, the premium payments being put into 4 different indexes as well. Like most of them are proprietary volatility indexes that have only existed for 5 years, 7 years, and whatnot. Like, and the participation rates on those change. So like I'm not being compensated enough for all that stress. And it was funny. You and I have dealt with a particular individual multiple times on YouTube. And the other day he posted a comment on one of Chris's videos. I think it was Chris's video about IUL, and he was having a conversation with somebody in the comments section. He said, IULs are not for lazy people. I was like, really? So I'm sorry that I'm too lazy to want to have to manage all of this garbage. I'm not trying to put more stress on myself like that on a product that is fundamentally flawed, extremely risky. I have to manage it like a hawk just for a couple of extra percentage points of growth potential. No. If I'm doing that, I need to be compensated accordingly. And IUL does not do that. It does not compensate enough for the risk, for the amount of management that it's going to require. I just, I don't see it. It's a pointless product when it comes to like what agents sell it as, way of building wealth, tax-free retirement income and stuff like that. I just don't see it.
Yeah.
You're better off, in my opinion, be an investor in the market.
Other problem is most agents, probably 99% of agents, they sell it as like a set it and forget it.
Right. Oh my God. It's the exact opposite.
There's no risk. You don't got to worry about it.
Oh,
so
man.
I'll say kudos to that agent for like admitting and saying, yeah, this is going to take, it's a lot of management. It's not for someone who's lazy. You got to be on top of it because you absolutely have to be paying attention. Absolutely. Every single year, right? These insurance companies change the cap rates. They change the par rates. Sometimes they change what indexes are available. So if you are in a particular index and it's discontinued, they might just put you right into the fixed account. Sure. And you might not be happy with that fixed account.
Sure.
Right. You got to be paying attention.
Yeah. it was just funny when I saw it, because normally I would take offense to somebody calling me lazy, because I'm definitely not. But in that particular case, I think that was the first time I was ever proud to be lazy. Right? You're like, you're darn right. I'm too lazy for an IUL. I want nothing to do with this crap. It's just not worth it. I got too many other far more productive things I'm working on than trying to manage stupid volatility indexes and worrying about cap rates and what the stock market's going to do. Nope. I want stuff that I'm in control of.
Yeah. The other thing too is, right, you have no control, right? You have no control of the market, and then you have no control of what the insurance company is going to do, and neither does your agent.
Yep.
Right. But from a perspective of, well, my agent's going to manage it, like
that's
you're asking your agent to predict which fund's going to perform, which one's not going to perform, and kind of predict the market. And they're not
and that goes against what agents sell IUL as. Like, I thought we weren't supposed to have, like, we didn't have to worry about these things. We don't have to worry about what the market's going to do, because we get upside potential, downside protection. And now you're saying we have to go from one index to another. Like, yeah, come on, man. What are we doing? Are we really rolling the dice with our financial future on this kind of stuff, on an agent's ability to manage this? Like, I thought you had to have a very specific license in order to manage money, but I guess because it's an IUL, it's a life insurance product, you don't have to do that anymore. But okay, that's a little bizarre. So they're like managing money now inside of a life insurance policy. And are they going to be in the business for a very long time? For like when as long as you need them to be? What happens if they quit and the next agent you're assigned or meet, like what if you can't find an agent like that again? Like, because a lot of agents selling IUL have no idea how IUL even works. Again, it's just all about the sale. So when you do find that one, unicorn agent that's going to do right by you, and again, you don't have control of what, how long they're going to stay in the business, what's going on with their life. You have no control of the stock market. You have no control of what the life insurance company does with the policy. You're gonna bet the farm on just for a couple of extra percentage points of growth. It's not there, man. It's not there.
I'd say this: if you're wealthy and you got extra cash laying around, you don't care to lose it. Like, hey, I'm all about taking risk.
Sure.
Like, take the risk. Go for it.
If it's risk you want to take, go for it. Just know what the risks are.
It's calculated risk, right?
Yep.
And there's nothing wrong with calculated risk. So I'm not saying that. But like you said, if you're putting all your money into this and you're betting the farm,
and you don't know how it works. So if I go to a roulette table and I bet whatever I have on black or red or whatever, I know what the risk is. And at that point, it's fun for me, right? And I'm not betting the farm on it, but I know what the risk is. So like, I guess, this is what I would close on, is at the end of the day, my big thing is just to do your research. Like my channel is all about, like, I'm just sharing my journey. And part of my journey was doing the research, because I drank the IUL Kool-Aid, almost bought one. It would have been a disaster after if I purchased the IUL and learned what I know now afterwards. Oh man, it would have been a disaster. It's just not in alignment whatsoever with my goals, my current situation. And then when I did my research on dividend paying whole life insurance, infinite banking, all that, that's when I was like, okay, this right here, this is what I was looking for right here. This makes perfect sense for me. But it's because I did my research. So if you do your research, you understand how an IUL works, you understand the risks, you understand the cost of doing simplified issue, you still want to do it, be my guest. You're a grown up. You can do whatever you want. Like Michael said, calculated risk. Absolutely nothing wrong with that whatsoever. All right. But my problem is I don't think most people know what the risks are. They only know what's being sold to them, what's being presented to them about all the great things of IUL, and they don't know what can go wrong, what the risks are, what all the things that could change, how much they're going to need to manage it. It's not a set it and forget it product whatsoever. So just do your research, guys. That's what I would close on. Michael, any final words as we wrap up?
Yeah, I mean, a lot of these agents are selling it as a no risk product, and that couldn't be further from the truth. So yeah, do your due diligence, find out where those risks are, find out how they're managed. And like I said, if you have extra money, hey, you want to take a calculated risk? I feel I could honestly take a calculated risk and probably come out okay, right? But is it the place I would choose to put my money? Absolutely not.
Yeah. It's just not there, man. Benefits are not there. So, hey, as always, Michael, great conversation, man. I really enjoy having you on the channel. I really appreciate your time. Guys, I'll link down to Michael's YouTube channel as well, IC Life. He's got some really good content, particularly around IUL. He has a lot of experience with it. So definitely check him out. I'll leave some additional resources and training in the description as well. Make sure you go through that. All kinds of stuff on infinite banking. I'll put some additional videos that we've done about IUL and just what you need to be aware of, the risks involved and how these things work. Just educate yourself, guys. That's all I'm asking you to do. All right. And before you pull the trigger on any of these life-changing decisions here in products. So anyways, really appreciate it, Michael. And I'm looking forward to the next one, my friends.
Absolutely. Look forward to it.
Take care.
Right. You too.